We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates. How are you today, Larry?
I'm great, Tom. How are you?
Excellent. Great to have you back and to chat about your, let's say, your third quarter letter here that you recently released. So in that letter, you say that the signs are beginning to appear that the everything bubble is faltering and fragile. So what are some of these signs that you're talking about?
Yeah, that's a great question. You've seen the momentum in the stock market really slow down. The stock market quarter on quarter was going up 10% and it's kind of stalled. We're maybe just touching among some highs, but particularly the triple Qs, which are kind of the leading and most, volatile and sexy part of the market, have not gone back to their highs. And, you kind of saw 5 waves down and 3 waves corrective. So that implies to me that there's a chance that they're in the process of topping. You're seeing this Evergrande thing over in China, and they'll paper it over. I don't think it's really going to be Lehman Brothers. I mean, it might be Lehman for them, but the Chinese government's very effective at, hiding things, and they'll do whatever they have to do to put it back in the bottle, I think. But the point is that, a very large real estate developer over there getting in financial trouble, over leveraged, trading down very rapidly, and then all the other related companies trading down rapidly as well. And then you see the stories of, the local people who bought these apartments thinking that they could only go up. And of course, the prices are starting to go down. And, that all has a little bit of a 2008 kind of feel to it. Again, I don't think the Western financial organizations are that exposed to it. And I think the Chinese will be pretty good at hiding it. But again, it's, if it's not growing, it's, going sideways or potentially shrinking. That's another sign that the bubble might be slowly deflating. I don't know. You see some other signs that it's not deflating. I mean, as everybody probably saw on Twitter last week, some guy was on Twitter talking about a stock, and when asked what they did, he didn't seem to know. Did you see that video?
Yeah. All of a sudden, his connection mysteriously.
Yeah, he had a very bad connection when he was asked the question, "What does this company do?" And to me, it's kind of just another sign of the top, right? I mean, I was around in 2000. I see a lot of things that remind me of 2000. I was an investor in the dot-com companies. I've been a venture capitalist and back a lot of them when they're very small. And, it has that same feel to it, the pets.com, sock puppet, and some of the silly ads that are being done. I mean, so you see all of that. Those are probably the top ones on the top of my mind. I mean, well, more specifically, in the United States, Q1. So last year we came out of COVID and we had this explosive growth in GDP. I think third quarter was up 30%, right? And then, of course, we had good growth in Q1 and Q2, 6 or 7%. And in July, the Atlanta Fed, who estimates GDP, was saying, well, Q3 growth is going to be 7%. And of course, they just came out and said, well, no, now it really looks like Q3 was actually closer to 1.3% growth. And so I think what you're seeing is that, we printed, trillions of dollars, and we threw one hell of a party, our so-called party, it's to get us out of the rut of COVID. And, but all that's kind of wearing out, right? The stimulus has not been re-upped, and the unemployment benefits are wearing out, and other forms of transfer payments have slowed down. And as a result of all that, you're starting to see the economy choke and slow down a bit. And so it begs the question of, are they going to have to come with more stimulus to keep things going, to keep it growing, to prevent the stock market from rolling over, or is the stock market going to roll over? And I don't know the answer to that, but I certainly know that it appears to be shakier than it was, when they were printing all the money, when, it kind of came roaring back. So That's kind of what I see.
In that vein, Larry, you were saying that the next round of stimulus has been stalled in a political fight. So how do you view this debt ceiling debate? And is there really even a point to it anymore?
Yeah, I think that's kind of kabuki theater. I don't know why they have a debt ceiling. They always overrun it. I think it's just it's another part of the whole pretense of they're being responsible when in reality they aren't. But we know the debt stimulus will be, the debt ceiling will be, overridden, and they'll go to some newer number, and before you know it, will be at 30 trillion of debt. I think a related issue there is that, there were senators. I mean, so one of the things that I talked about in my letter, one of the things that happened, in the past 9 months or so, is, as we know, the thing that's the big elephant in the room is that inflation is raging, right? Inflation is breaking out everywhere. And we could spend a day talking about where you see it. You just see it in everything. U.S. houses are up 23% year on year. It's crazy. Mm-hmm. There's just nothing that's going down, or very few things that are going down in price. And so, and obviously the politicians aren't stupid. They saw that too. And they realize that's a problem. And they also realize that we printed 40% of the money in existence in the last couple of years. And so, I think they kind of said to themselves, hey, hang on a second, we got to pull back on this. Biden's talking 3.5 trillion of stimulus, but if we do this, we're going to just stoke inflation, croak the dollar. This isn't such a good idea. And the leader of that has been this Joe Manchin, the Democratic senator from West Virginia, who's been the most conservative guy. It's kind of prevented the Democrats from doing a lot of the stuff they want to do. And so, I think they did all this because they realized they had an inflation problem coming. Now, I don't know, if they're going to like the alternative, which is severe deflation, if they don't eventually come through with more stimulus and more money printing. But, they're in this pickle where they got to do one or the other. And, if they don't print, that's okay. That's a choice. But guess what? Stock market's not going to stay up. Economy's not going to stay up. Things are going to slow down. Maybe inflation will cool a little bit, but things are going to go south. And in turn, if they want to keep that economy going, they want to keep the growth going, they want to have a chance at kind of quote unquote growing their way out of the big debt burden, they've literally got to keep printing money and got to keep stimulating the economy directly, not just through printing money. With stimulus checks, they're going to have to do more of it. So that's the trap that they've set themselves into. And it's fascinating to see it because it's so clear. But what's not clear is how it's going to get resolved. I think what will happen, my opinion, my guess as to what will happen is that the stock market has begun to roll over. It's going to roll over further. The fourth quarter economy is going to look pretty bad. I was just on Twitter this morning about, look at this, Jay Powell's going to get fired. Okay. And they've already got 2 new open seats on the Fed board. So they're going to bring in 3 doves. And, and then the Congress is going to turn around and do a big stim package. And, they're going to try and keep things going again, which, by the way, for the assets that most of the people who are watching this are probably concerned about, gold, silver, and Bitcoin is just going to be rocket fuel. Our stuff's going to take off like a scalded dog. Mm-hmm. But, it's rather frustrating and disappointing that we've kind of had to, live through this pullback. Although having been at this since 2008, I can actually say this is kind of one of the milder ones. Goes like 15% off its high. It's not, it's not the end of the world. And I was just at these gold show conferences out in Colorado a little while ago, a month ago or so. And what was interesting to me was that all the companies were sitting there saying, hey, this is great. If you had told us 3 years ago when gold was $1,200, if you'd have told us $1,300, if you'd have told us gold was going to be $1,700, $1,800, we'd have said, hallelujah, that's great. Mm-hmm. And they're making huge amounts of money at those levels. Industry average ASIC is about $1,000. So, $1,750 gold gives you $750 of profit on each ounce. So, they're doing great. It's, now obviously they'd like the price to be going to 2,000 or 2,500. They'd be doing even more great. And I think that's, the fear that we're going to go back to 1,500 is why the stocks haven't traded better. Mm-hmm. But, the reaction was, we're doing great. Why isn't our stock doing so well? And I think it's because people are thinking, well, maybe the government will become responsible. And the government has been a little more responsible recently, but that's compared to an incredibly irresponsible level. And when one looks at what they need to do to keep the system going, we're pretty sure they're going to go back there. At least I'm pretty sure they're going to go back there, which is why I'm very comfortable, with the asset allocation bets that we've made.
So in that vein, Larry, this is kind of why you're saying that the Fed starting to taper in the fourth quarter is a bluff, right?
I think it is. I don't know though. They're really good at peas and shells and changing the rules of the game. They may actually taper, but figure out some other way to get the money into the system. Do you know what I mean? Because they know that everyone looks at the taper. Mm-hmm. They did Operation Twist. These guys, they know what they're up against, and they're not stupid. They're evil, but they're not stupid. And so, they're going to try like hell to keep it going and pretend like they're being fiscally and financially responsible. So they might actually taper. But if they open up the repo lines to absolutely everybody and take the repo, the repo rate is incredibly low, and they're pumping money in through the side door. I mean, I think Luke Groman used the analogy, does it matter if we stop giving the guy heroin injections in one arm and we put a heroin, IV drip in the other arm, right? I mean, you get to the same place. You're getting lots of heroin. Mm-hmm. So, I mean, that's kind of how, I don't know. I think there's a decent chance that they will have to literally stop the taper to reassure markets. I mean, I'm kind of reminded of some of your listeners may or may not have been around in 2008 when the crash happened and they came in and they said, we need TARP. We need $700 billion of TARP right now or your ATM's not going to work. They went to all the Congress people and, Hank Paulson's down on his knees begging for it. We got to have this TARP. Congress got 100-to-1, outrage from their constituents that said, no, don't vote for this. It's a bailout. You're making the bankers rich. It's wrong. Okay. So they voted it down. Well, next thing the market sold off hard. I don't recall the exact amount. I can go back and look, but it sold off really hard. And, a couple of weeks later, they brought it again and it passed overwhelmingly, right? Mm-hmm. Because, and I think that's what's going to happen here, right? I mean, sure, they're bluffing that we got inflation under control. It's all good. We don't need, we can withdraw this stimulus. It's all great. Well, it's like Mike Tyson said, that's their plan. Let's wait until they get punched in the face. When the market's down 15% and, there's no bid for the treasury bond and the T-bond 10-year bond yield is going up very quickly like it did in March, and the dollar is sliding hard, you watch. I mean, my sense is that, okay, well, maybe we do have a way to do stimulus and to reverse this taper. And in fact, another point I'd like to make is that they probably have to come back with even more. I mean, one of the things that's going on here that I find interesting is the way that each time this occurs, the dollar figures get bigger, right? I mean, in 2008, when this whole thing blew up, they put about $3 trillion into the system over 3 years. In this particular instance, we put, $5 trillion in the system over, 4 months or less, right? So, on the next one, what are we going to do? Are we going to put 10 trillion in the system instantly? I mean, it's, if there's a chart in the quarterly report, which is available on my website, that shows you that just kind of the rate of growth of the money supply is accelerating. Mm-hmm. And it almost mathematically has to accelerate because if it doesn't, somebody defaults, some piece of interest doesn't get paid. So, it really is back to the old Richard Russell thing of inflate or die. Mm-hmm. They can choose not to inflate. Yeah. If
you can't taper a Ponzi scheme.
Yeah, exactly. That's another great way of saying it. You can't taper a Ponzi scheme. So, mm-hmm. We'll see. I mean, I think it's certainly an undecided question as to how it's going to play out. It always is. And there's a lot of politics involved. I mean, this is going to end badly, but all the politicians are going to try like crazy to make it end in such a way that they don't get the blame. In fact, I saw that recently where some politician was talking about how, there's some publication made the argument that, Bitcoin was going to crash the financial system and that Bitcoin was the fault. It was, if things go bad, Bitcoin is going to be at fault, which, is not entirely untrue, but let's not forget that Bitcoin didn't create the things going bad. Mm-hmm. I mean, things have been going bad here for a long time. And, gold and to a degree, Bitcoin are the solution to things going bad. Sound money is what we need to return to. It's unsound money that has created the mess that we're in. And unfortunately, we're getting closer and closer to the end game. I mean, the analogy I use in the speech I'm going to give down in New Orleans this week is that, the unsound money guys, they're like the guys who jumped off a building. I think I've used this with you in the past. They jumped off a building, said, hey, look, I can fly. It's great. I'm flying. Mm-hmm. Well, they're passing the lower floors right now. And the ground is coming up fast, at least as I see it. Mm-hmm. So we'll see what happens.
So as we mentioned, GDP growth slowing to 1%, you wrote in the letter that, quote, the government has not stepped up with additional stimulus that has resulted in a marked slowdown in all economic measures, with the notable exception of inflation. So What time in history does this compare to, and what were the outcomes of that period, Larry?
Yeah, absolutely. That's a great question. Thank you. So this is, we all know that no growth and higher prices, that's the definition of stagflation. And that's the definition of the 70s. Now, I was a kid I was born in 57. So, I was in my teens during the 70s, but I remember it very clearly. And it was just relentless. The price of everything just kept going up over and over and over again. And in that particular instance, the two best performing asset classes were gold and oil. And I think in the case of gold, it went up at a 30% compound annual rate. And I think oil went up at like a 17% compound annual rate. I mean, they were both really, for 10 years. And, bonds got killed, just absolutely killed because interest rates were going up. And stocks, kind of got killed. I mean, they had some bull market rallies and some bear market, but they kind of went nowhere. You didn't make much money in stocks. You lost a lot of purchasing power in bonds. And then if you were in gold or oil, you did extremely well, both energy related things, because gold is really just stored energy. So, yeah, I feel like that's where we're going. This feels very 1970s like to me. Yeah.
So when we think about, what we need to get gold kickstarted again, kind of, could we need, not necessarily just another stimulus package, but maybe another fear trade moment to build that momentum again?
I think that'll help. I mean, probably the best thing we need is to, get the BIS and all the bullion banks out of the game. I mean, it's so heavily manipulated, but yes, I mean, it's a matter of a number of things. I mean, I think people need to, there was a survey that said it's out of date now, but it was 4 months ago. It said that 70% of the people think that inflation is transitory. Well, I think that's going to dissolve. I mean, I think people are going to, finally, with all these supply chain things and, transitory is a few months, we're going to be into years and years of deflation here, and it could arguably be getting worse throughout that period. So as transitory dissolves into permanent inflation, that's going to really change investor sentiment a lot. And people are going to say to themselves, "Oh my, I've got to protect myself against the debasement of my purchasing power." And so, some will go to stocks, and stocks represent somewhat of protection because they are an enterprise that can reprice and so forth. But a lot of them will also go to, the thing they'll get out of, the worst asset obviously will be bonds. So they get out of bonds, and that might force the Fed into yield curve control. But then they'll run into, hard assets. And actually, you're kind of seeing that in the housing. I mean, I think it's fascinating that U.S. housing prices are up 23%. It's not because we have a shortage of housing. That was bigger than the housing bubble. And one year-on-year growth of 23%. Well, I know what that is. That's just housing guys doing the Hugo Stennis trade, where they're, a house is something. It's something you can use. Two, it's something that theoretically protects against inflation. I mean, it does have taxes and it depreciates over time. But in general, a house is a real thing. It's not a bond. And, and three, you can buy it cheap. I mean, the government will give you 30-year money at 3%. So if inflation is really running at 7 or 8%, so the value of your house is going to go up. Well, this year, housing prices, inflation went up 23%, right? Mm-hmm. And you can borrow money at 3 to do that for a 30-year window. That's like a no-brainer. Mm-hmm. That's just a complete no-brainer. So you're seeing it there, and, it's a combination of factors, Tom. I think it's just a matter of time and investor psychology changing. And to me, this period in the gold price reminds me a lot of the period around 2008, where, 2007 or 8, it kind of hit the old high of $800, which was the old high from 1979, 80. And we had the old high from 2011 was 1900. We hit that and beat it slightly last summer, went to 2050. Came back underneath it, went down in the 16s. Now we're back in 1750-ish range. And, we're fighting to get through that 1900 permanently. And then 2000. And once we do that, it's going to take off like a scalded dog. I mean, it's just going to be, the inflation trade is going to be on, and it's going to be something to behold. So it's going to feel like last summer felt. Mm-hmm. But, we're not quite there yet. I mean, there's still a lot of people, haven't figured out where inflation is. There's, there are people saying deflation will return, and it's been a deflationary world and so forth. So I think it's going to take, a little bit more of beating investors over the head. And it's very common for people to invest in the rearview mirror. I mean, look, the deflation trade has worked for 40 years, since 1980. But you're seeing, and it's so funny, you're seeing all these mirror images of things changing in 1980. I mean, I remember 1981, Reagan broke PATCO, which was the air traffic controllers union, basically fired them all and hired new guys. And, that was the beginning of the downturn of unions and union pricing power and the power of labor and everything else. And, just recently I read that John Deere, the entire company went out and they're not going back until they get better living wages. The whole country's watching them. Mm-hmm. And, so you're going to see a trend. I mean, this 40 years of deflation benefited, Wall Street versus Main Street. And I think that's changing. I think Main Street's so angry, and by the way, there are job shortages, so that Wall Street and these companies are going to have to pay people more. They just have to, and higher inflation is going to cost them more to live. They're going to demand higher wages. I mean, that's the thing. When you get into an inflationary environment, it's a cyclical thing. It's a cycle, and it has a psychological point to it. I mean, you buy things that you may not even need because they'll be more expensive in the future, which increases demand for those things, which then increases price for those things, which then increases inflation, right? So it's like it's a terrible vicious circle, and it can happen. And I saw it happen. I mean, in the 70s, I remember my parents would buy a used car or a new car and could sell it used or trade it in used and get more credit for it than what they paid to buy it. Of course, the new car they were buying cost even more. But the point is, since when have used cars actually gone up to values over and above their sticker price? I mean, that only happens in a highly inflationary environment. You're seeing it now. Mm-hmm.
So you mentioned that 23.6 year over year increase in housing, and that, like you said, that was more than the housing crisis. So is this another sign of the everything bubble, Larry? And how safe of a bet do you think that this housing market investment could be?
Well, I hear you. Is that a bubble? I mean, it's, I think, it has, look, if we go into a severe deflation, okay, and deflation is the outcome, the price of everything will fall, okay, including housing, because people will be over indebted and they'll need to liquidate at whatever price they can get to make their dollar commitments, okay. But I think that, the bet I'm making, and I think the bet that is intelligent to make, and perhaps but it's not guaranteed, is that the politicians will just never let us go into deflation. I fall back on the Ben Bernanke 1982 speech, that we have this technology called the printing press. Mm-hmm. And deflation can't happen here because we'll just continue printing money as needed to prevent it from occurring. Now, of course, the corollary to that is fine. You'll print as much money as you want, but what will it be worth per unit, right? So, so yes, there could be a bubble in housing. There's a bubble, in a sense, there's a bubble in all assets. But I'll tell you what, I'd rather have a real asset like a house than have a pumped up asset like a FANG stock that trades at, peak earnings multiple on peak earnings. I mean, the thing I think people aren't factoring into the stock market is, this inflation is going to filter into these companies. I mean, right now we've got peak profit margins and we've got peak multiples on those profit margins. Well, if suddenly, and so if a company has pricing power and all their costs go up, well, they can pass it along and maybe maintain their profit margin. But if they don't have pricing power and their labor costs go up, their fuel costs go up, their heating costs go up, all their input costs go up, their profit margins are coming down. So peak profit margins aren't going to exist. And so, lower profit margins at super high multiples, those multiples are going to come down. And so, I think the stock market could really potentially have a very big accident. I mean, in the 2000 example and in the 2008 example, the S&P corrected 50% off its high. And I think that's entirely possible. I mean, I do feel like this is the third bubble that the Fed has blown in a 20 some odd year time frame. Bubbles typically don't end well. Having said that, I'm sure you're familiar with the concept of a crack up boom. And, in turn, they could just keep printing so much money that the stock market could double from here. Mm-hmm. Now, the cost of all goods and services could double too, right? I mean, that's what a crack up boom is all about. And it's really the currency kind of failing. So it's very hard to, look at the monetary environment and know with any kind of certainty exactly how this will play out. Mm-hmm. However, there are some things that I think are pretty simple to figure out. One, you don't want to be in bonds. You just don't. If you decide you want to hold cash because you're worried about deflation, fine. Hold things that are cash or cash-like. I prefer gold or silver as cash because they can't be printed. And they're convertible to cash. And they're 5,000-year-old sound money. So, there's an argument. I mean, if you're worried about deflation, then you should have a lot of cash. If you think prices, they'll let the thing collapse and, prices will fall and you want to be able to buy things, fine. Get a lot of gold and silver bullion, stay and get a lot of just dollar cash. But, I think that to not be in things that protect against the tail event of super high inflation is very irresponsible. And so in that bucket, I put gold, silver, Bitcoin, and gold and silver stocks. Mm-hmm. So that's where our fund is professionally, we try to professionally manage the risk in this area and balance, all the trade-offs amongst those asset categories. And it's not easy. I mean, it's not easy to know what's going to happen. And that's why diversity is an intelligent thing. I mean, I think everybody should hold some cash, in case we do have deflation.
So, Larry, when we think about this inflation deflation cycle, how do you view the progression of these two forces? How do they play out over time?
Yeah, boy, Tom, I wish I knew, man. I really wish I knew. I mean, all we can do is just watch the signposts. I mean, the prices give you information, and unfortunately, even the prices are somewhat distorted because I think the Fed buys the stock market, and I think the Fed manipulates the gold and silver markets, but still, those manipulations can only last for so long, and I think will ultimately blow up. I think you can also watch the Congress and the government and what they're doing. I mean, they're either going to print more money, continue to expand the money supply, and do additional stimulus, or they're not. And I think the trick is to be nimble enough and to understand that they probably have to do those things. And so that if we start off with a deflationary impulse, you don't want to get blown out of your positions. I mean, let me give you a perfect example. In March, March 2020, when the COVID thing hit, I was in all these assets and they got destroyed, just like everything else got destroyed because we had an enormous deflationary impulse. And I'll tell you, it didn't feel good at all. I mean, to any of us who were in this area, it felt horrible. And yet, we could sit there saying, okay, this is deflation for sure. This stuff's not working at all. But we know what this means. The government's going to respond. And sure enough, in came Jay over the top with, we'll do whatever it takes. We're opening up the swap lines. We're opening up the floodgates. We're backing the bonds. They came with all guns blazing, and there were a couple of days there where gold was up $100 a day back to back. And all my assets were up, 50%, or 40% within weeks. So, I think what's important for investors to understand is that this volatility is likely to be present. And, therefore you can't overbet your hand. I mean, if you'd been totally levered long in all the stuff I was in and had been getting margin called, you'd have gotten blown out. Mm-hmm. You wouldn't have been able to hang on for the good part when Jay came in and made, because subsequently, my fund went up, 97%, and then it went up 126%. So, it's like, but I wouldn't have been there to get that if I'd gotten blown out on the leverage going down. And on the web, there's a great Google, the Mermican hyperinflation chart. And it shows just how volatile things can be when you're in one of these very inflationary periods. And, you can be right, but if you're on leverage and you get blown up, well, then you're not going to live to see you're being right. So, and that's why I think the prudent thing is to have a mixture of these assets. I mean, yes, have some cash. Yes, have some gold. Yes, have some silver. Yes, have some Bitcoin. Yes, have some gold stocks. And everybody's got to decide, where are they on the risk spectrum and what can they handle? Can they handle big drawdowns? I mean, Bitcoin's a fabulous asset. I love it. I think it's got enormous upside potential. It's really important in my view, but, it also has had 50 to 85% drawdowns. And, if you were in Thanksgiving of 2017 and you were brought into your young cousin said, you got to buy some Bitcoin, and you chased it and you bought it at 17,000. Well, and then it went to 10,000, then went to 3,500. And guess what? You might have felt like an idiot and blown it out. Of course, that was the wrong thing to do. But the point is, some people can't handle volatility and drawdowns. And if that's the case, they shouldn't be in assets that are going to give them that kind of stuff. Gold doesn't have 85% drawdowns. It just doesn't. It's a much more stable. It's been around longer. It's more widely held, et cetera. So, I think everybody needs to kind of figure out what's right for them, given their risk tolerance and given the way they view the world working. I just think that's an important point that some of the people who are kind of like, all Bitcoin all the time, 100% miss, and because that's not the right answer for every person. I mean, don't get me wrong. I think it's got fabulous upside. I really do. I think it's very important, but I won't be 100% Bitcoin ever. I couldn't be there.
Larry, I want to ask you a couple more questions about Bitcoin,
Sure.
But you did mention earlier, and you also mentioned in the letter, there's some distinctions between some of the gold mining stocks. So what sector of the gold mining complex looks most promising to you at this time?
Yeah, that's a great question, Tom. Thanks. So let's put the gold mining complex at three buckets, right? In the gold mining world, there's the drill stories. These are the guys who found some good rocks, usually on a trend. Other gold stuff is nearby, and they're like, hey, based on this Aeromag and other things, if we poke holes here, I bet we find gold. That's a drill story. And the thing that's great about them is if they're right, oh my God, you can make enormous amounts of money, 5, 10, 20, 100 times your money on the initial investment. Of course, many times they're wrong. So that's a drill story. Then the middle bucket is the development story. These are the people who have proven gold. They've got a 43-101 measured resource, and they're trying to turn that into a gold mine. And they say, if I had this amount of capital, we'd build this mine and it would throw off cash flow of $100 million a year. So please give me the capital. And when it does, it'll be worth a lot more. Okay. So that's a development story. And then the third bucket are the producers. And of course, within all these buckets, some of them overlap because there are producers who are also drilling, but I'm keeping it simple. In the producer bucket, guy already has a gold mine, says, I got a 10-year life. We're mining 100,000 ounces a year. That generates $80 million of free cash flow, and if gold price goes up, we'll make more. And our ASIC is $1,000. So, and the producers right now are the most compelling area to invest in. A couple of years ago, it was the drill stories, because you could actually find good drill stories that had already found gold that were silly cheap. I mean, it's just unbelievable. And then we did that, and that's why we did well. And now the drill stories are more fully priced than they used to be. And it's not, we're doing them, but it's just not as attractive an area. But over on the production side, this whole pullback, the production production's not sexy. It's generally just kind of, we're just making every year we mine more gold, and we drill for more, we replace what we mine. And maybe some of the production stories have a development piece where, we can expand the capacity and we'll add some more, or maybe we'll build our second mine and it'll get bigger. But a lot of them aren't even doing that. They're just producing gold and throwing off cash. Well, what's happened to some of those is that they've really gotten compressed in price. And as I say, they're not sexy the way the drill stories are. And so, some of these things are trading at 2 or 3 times cash flow. And it's like, this is nuts. And I'm not talking small companies. I'm talking like billion-dollar companies. We've got a couple of billion-dollar companies in our portfolio that have 400 million of EBITDA, and they're trading for $1 billion. That's 2.5 times cash flow. That's a 40% earnings yield in the 0% interest rate environment. It just blows my mind. Mm-hmm. So that, to me right now, that's the easiest bucket to go picking in. The middle bucket of the developers, that can be a pretty good bucket. The one risk there that's popped up is, as you might imagine, with all this inflation, all this COVID, these guys have all modeled and said, all right, we're going to build this mine and it's going to cost us $100 million to do it. We need steel and electricity and blah, 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 all these inputs. Well, guess what? All those input prices have gone up. And so now it's not $100 million to build it, it's $130 million to build it. Well, okay. You're modeling out an IRR of 40%. Now that higher capex up front, your IRR is 23% or something. Everything comes in. So the development stuff has gotten trickier. But to me right now, the biggest sweet spot are these developers, these producers who are trading at low multiples of cash flow. And then some of them actually have some growth. And then some of them also have a lot of operating leverage where they maybe tend to be a little bit on the higher side of the production cost. So if you believe in higher gold prices, their earnings are going to grow really rapidly. So, it's a powerful combination. If you're going to grow your production, if your, price of gold is going to go up, so your profits are going to grow. And then if you're going to get some multiple expansion, so some of these are trading at 2-3 times cash flow, in a real roaring bull market, 10 times cash flow, you've heard of that many times. So, you're trading at 3 times and you go to 10 times or 9 times, you've got a 300% gain. That's without changing the price of gold or the number of ounces you're producing. So, grow the price of gold, grow the number of ounces, expand the multiple, you got 5 baggers or, maybe even 10 baggers, if you give them a few years. So So there's some really, really rich and interesting opportunities, and we're very excited about them. And we, as we get out of this trough that gold is kind of seems to be stuck in, it's quite annoying. As we get out of this trough, we believe that we're going to make a ton of money. Mm-hmm. I mean, and the people who are in these companies are going to make a ton of money. So it's it's a very good place to be, in my opinion. I mean, some people say, what can go wrong? Let me just comment on that. I mean, what could go wrong is if the governments get really responsible. I mean, if you feel like governments are going to means test Social Security and cut back on expenses and cut back on defense and if governments got fiscally responsible and tried to balance their books, that would be bad for my thesis. And my fund probably wouldn't do as well as I hope, or well at all, to be honest with you. But I'm pretty comfortable that that's not likely to happen, at least not in the shorter term time frame. Longer term, it could happen. So. It
doesn't really seem that there's the political appetite to make that happen, number one. And number two, that speaks towards your idea of being nimble, right? And watching.
Yeah, I think that's right. I mean, I agree with that. I don't think there's the appetite today. Now, look, when inflation is raging and, we're seeing protests over inflation and, everybody and their brother knows it's an enormous problem, then and politicians are literally looking at being thrown out of office unless they have a plan to deal with it. Well, then, plans might start to pop up and that'll be something to consider. I mean, and we may want to try and do something in terms of lightening up on some of these things before that happens. But I don't see any evidence of that right now. I mean, I do see that they put their foot on the brake because they realized that they had a runaway inflation train. But I think, they're going to, and now to keep their credibility, they're even kind of saying things like, well, inflation's a little worse than we thought, but it'll be over in a few years. They're kind of they're buying themselves a little
now.
Bit. Yeah, exactly. It used to be real transitory short. Now they're buying themselves a few years at a time because they know they got to keep it going, or else this thing implodes. Mm-hmm. They know that, and it's not bad enough yet. I mean, it's bad in my opinion, but it's not bad enough yet that you got the whip inflation now buttons and everyone's protesting, and it's the top topic on literally everybody's mind. It's getting there, and it could be that bad in a year or two. I think it might be, but I don't think it's quite there yet. So I think they're going to let it rip. I mean, I think they're going to, as this economy slows down, the stock market rolls over, they're going to come with more stuff, and it's going to rip. Gold's going to go through 2,000, and we're going to be fine.
So when we think about these, let's say, inflation hedging assets, Larry, and we think about let's say the age-old debate of gold or Bitcoin, what kind of brought you over to the Bitcoin side? Not saying that that's over gold, but can you provide us with some context?
Yeah, let me give you some context here because it's a long story. I mean, I was involved with Ron Paul and I ran some ads for him to be president, and the New Hampshire Free State Project, a lot of them were Bitcoiners. And so I heard about Bitcoin very early, like 09, 10, 11. I know a woman up there who was a secretary, bought a bunch of Bitcoin at like $2 a coin. She still holds them. She's done really well. It's a great story. I mean, she didn't know anything about them. She's just part of the Free State and said, hey, you should buy some of these. And she got hundreds of them. So anyway, so I knew about it very early, and I couldn't really buy it because it was off exchange. It was crazy and wild. And I almost bought some through Fort Cox. Thank God I didn't. And then after Fort Cox, I bought my first ones in 2014 when it came on the scene with Coinbase. And it was about $300 then. And I've just kind of continually been buying it since then. I always viewed it as, this might actually be a private alternative form of money. And the more I followed it, the more I studied it, the more I understood it, I got more and more comfortable with the technology. I mean, I guess in the early days, my fear was always that it's a computer and it could blow up. I'm very used to, I had all these old IBM PCs. I was very used to blue screens, and I'm just like, anything that's on a computer is going to get blown up. And in fact, I even went to an MIT forum, and I sat next to a Bitcoin Core developer, and I said, what do you worry about? He says, well, I worry about sometimes when I make a change to the code, I go home, I think I'm going to blow up the whole network. And I was kind of like, oh shit. And that kind of scared me a little bit. But time went by and the network didn't blow up. It kept on working. And I kept studying it, and I realized, this is, if you think about what money is, and this is where I think a lot of gold people get tripped up. They feel like there's something about money has to be physical. And if you think about at an abstract level, if you think about what money is money's really just a record of who owes who what, kind of keeping track. I mean, you actually don't even see physical dollars. We have a lot of digits in your bank account, right? I mean, so it's, and before gold even existed, guys sat around in caves and said, okay, I killed 3 bison, you killed 2, I owe you 1, and so money is a way, I view money as a ledger and a way of keeping track of things. And so Bitcoin is an immutable digital ledger with a limited supply. And money controlled by governments, the big problem with it is they've never been able to limit the supply. I mean, it's Voltaire, all fiat money goes to its intrinsic value, 0. And so gold always represented a private alternative that couldn't grow at excessive rates. It did grow. It goes up 1.7% a year, the supply. But and here comes a guy, Satoshi, we don't know who he is, who developed a system that electronically keeps a ledger that can't be messed with. And, at first I thought, well, that's too good to be true. It's going to blow up. But it really hasn't blown up. And so it hasn't been messed with. And has it got problems? Yeah, you can steal the keys, and there are issues with it. Or you can lose the keys. If you do, you're totally out of luck. But the bottom line is it works. It's an immutable digital ledger, and so I think as more and more people have come to see that and see some of the advantages about it in terms of verifiability, it's available to the public and so on and so forth. They've come to accept that it is a good store of value and it is sound. And the stock to flow is not quite, it's about where gold is right now. In the next halving cycle where they're less produced as a result of mining, it'll be sounder money than gold. And history shows that the soundest money always wins. I mean, gold demonetized silver because it had a lower stock or higher stock to flow. So, and China and India, who had bet heavily on, silver, suffered greatly as a result of that. And so some of the Bitcoin people say, well, Bitcoin's going to demonetize gold. And I'm like, okay, Tiger, slow down. I mean, Bitcoin is playing a role as an alternative to gold, but I actually see them more as cooperative rather than competitive. And I'll tell you why. The real enemy here is the fiat system where the government can print and counterfeit money. And, and by the way, they'll change the rules, they'll break the rules, they'll do whatever they can to keep that going because, hey, it benefits them, right? And so both of these forms of money, gold and Bitcoin, represent a protest against that system. And they're different protests. I mean, to me, gold is analog money, and Bitcoin is digital money, right? And they each have positives and negatives. I mean, when gold is mined, you have a gold coin, the energy is totally spent. You can see it, you can hold it, you can touch it. It's beautiful. It's indestructible. It's wonderful. And so there's no ongoing energy deficit. Bitcoin is an entry in a ledger that requires energy to keep it going. And, that's an issue, right? I mean, it's not an enormous issue. I think it's an overcomable issue, but it's different than gold. I mean, another benefit of gold is you have a gold coin that you get in trade. Nobody knows you have it. You have some Bitcoin, it's on the blockchain. There's a record of it. Now, it's pseudonymous because they don't necessarily know what your address is, but I think that's going to change. I think the government's probably going to make people start to tell what they've got. I mean, they've already make us check a box that says we own cryptocurrencies in the IRS. So there's a privacy loss there potentially with the Bitcoin. And, but Bitcoin, it's a fabulous invention. I think it's going to be a very important invention. And I do think it's an existential, just like gold, I think it's an existential threat to fiat currency. And, what's exciting to me about it is that, I've been an Austrian economist. I've been a gold guy since the early 80s. I've been fighting this battle for sound money for a long time. And here we are, we got this new invention and, all the millennials read Saifedean's book, the Bitcoin Standard, and they become Austrian economists and sound money people. And they realize how screwed up the system is. And they finally got a weapon to fight with, and it's Bitcoin. Mm-hmm. And so they dive into Bitcoin and go 100% Bitcoin. And I'm like, hallelujah, guys, have at it. That's great. That's absolutely great. Again, back to the asset management side, I believe in a balanced approach. And, my fund has Bitcoin. It's about we're about 80% gold weighted and about 20% Bitcoin, which I think is about the right balance for, the spectrum of investors that I have and what they're looking for. Mm-hmm. Does that mean gold is going to perform as well as Bitcoin? Not necessarily. I mean, Bitcoin might perform better, but it'll also be more volatile. We know that for sure. Mm-hmm. It's 2 to 3 times more volatile than gold. So, so there's a place for both of them, I think, in a in a sound money portfolio. And I think that of all the bets today, I've always been a macro theme guy. I mean, my best investment success, I was a tech investor as a venture guy from the 80s until 2004. And in that time frame, my best success was picking up on the internet theme in 93. Just said, oh, wow, this is a really good invention. And actually, Bitcoin reminds me a lot of the internet. It really does. It's kind of network effect, et cetera. And so, as a theme-based guy, I think the theme of sound money is a really important theme right now. You look at what's going on with the governments, you look at the way they're printing money. I mean, I don't think there's any macro bet that's as obvious as the sound money bet. Okay, great. So you got that as your starting point. Then where do you go? I think you got to say, all right, I want to go to, the various sound money alternatives, and gold, silver, Bitcoin. Those are, and gold and silver mining stocks and Bitcoin infrastructure stocks, by the way. I mean, our Bitcoin weighting is not just, we didn't just buy the coins. I mean, although we have coins, but we've actually, invested in some Bitcoin infrastructure companies. We have a Bitcoin miner that in the last round of financing, it got marked up 10x from what we originally paid for it. So, there will be a lot of companies that will build up around Bitcoin, just as there were a lot of companies that built up around the internet. And of course, there'll be some that fail too. I mean, not everything that came out of the internet, craze made it. A lot of them failed. So, there's risk there. But the point is that Bitcoin's important. It's extremely important. In fact, like I say, people are interested. I'm going to New Orleans this week, and I'll be presenting at the New Orleans Gold Show. And if you want to watch it live for a modest fee, you can register and watch it live. But probably after a week or so, they'll release the video and it'll be up on the web. The speech I'm going to give, because it talks about this issue of sound money and why it's important, and then how we look at kind of balancing the alternatives in the sound money bucket.
So Larry, is there something about China's move to ban Bitcoin that provided momentum for it to break its all-time highs, as we recently saw over this past weekend? Yeah,
I don't know if it was related to the all-time highs, but I'll tell you this. I think you and I were talking about this online before we got going here. I think China just really blew it. And it makes sense, right? I mean, they've got, they've got a strong economy. They've proven that they're pretty good at stealing stuff and making things cheap because they've got, slave labor. The freedom and distributed nature of Bitcoin does not fit into a communist command and control economy. And so they've obviously decided that they are not going to bet on Bitcoin. They outlawed the miners, which brought them all over here. And they've outlawed Bitcoin, although I think a lot of people still transact and use it kind of in various ways over there because they can get around the restrictions. And I think that was a bad strategic bet on their part because, and they've obviously bet very heavily on gold, which frankly is good for all us gold holders because, I see the world evolving in a way where, we've got kind of parallel things going on. I mean, gold is sound money, Bitcoin sound money, and they'll both fill a role. But they've obviously made the bet that the form of sound money they want to support is gold. We know they've bought a ton of gold. We know it. It's the Swiss report it. And we know they're hostile to Bitcoin. Hopefully the U.S. will not be hostile to Bitcoin. I think they're not. I mean, Gary Gensler has said that he's a Bitcoiner and he taught a course at MIT on it. He's the head of the SEC, obviously. And he said, we want to regulate it. We don't want, investors to get ripped off. And we think a lot of these altcoins, they're promotions and pump and dumps. We think that stuff's bad. And he's right. That stuff is bad. I mean, Tether's probably bad. I mean, it's, it's not transparent. You can't see how they're running it, et cetera. So and that's part of what makes it also challenging. I mean, to just a standard old fashioned gold investor, you look at all the noise in the crypto space and you say to yourself, God, there's a lot of fraud and bullshit here. And there really is. And so I understand why a lot of gold guys go, shit, I'm not touching this. This is all horse shit. But you got to dig into the technology of the actual one thing that counts, and that is Bitcoin. And that's, Bitcoin maximalism, which I think there's a big difference. I mean, in fact, when I say to some people in the Bitcoin world, I say, oh yeah, it's a cryptocurrency. And they immediately, caution me and say, we don't do crypto. We do Bitcoin only, because these other things, they're not Bitcoin. The Ethereum is not Bitcoin. A lot of these other tokens, they're not Bitcoin. I mean, there is something very important about the way Bitcoin is distributed and self-verifying through all of these various nodes. And the proof of work protects the sanctity of those transactions. So, It's a very powerful concept. And I think gold people should really, I say to my clients, I say, look, it's not about how much Bitcoin you own. It's about owning more than zero, because it's got a lot. It is working. It is growing. It's got a lot of optionality. And if you actually do the math, if you math it out, and I think the mistake a lot of people are making is they're looking at it and saying, well, God, I missed it. I wish I bought it at 5 or 10. It's at 50. How can I pay that much for it? It's got to be a bubble. Well, let me just give you an example. I did the same thing on Amazon, and I did the same thing on Facebook. These self-referencing network businesses tend to continue to grow. And it's kind of stunning how much, the networks don't grow arithmetically, they grow geometrically. And therefore, it's kind of stunning how much value they can accrue as more and more people come to use them. I miss Google, same thing. So, I would say to people, hold your nose and buy some. Now, knowing that there could be 50 to 80% drawdowns, I would also say the right way to approach an asset that volatile is to dollar cost average. Go to Swan Bitcoin, set up an account. I've got one now. I buy Bitcoin every week. I just take a little bit and buy some Bitcoin. And when it was at 30 grand, I bought some. I got a little more. Now it's at 60. My fixed amount of purchase, it's a little less. And I'll probably be buying it at 70 and 80. And it just, because I sincerely believe it's going to much, much higher numbers than it's at today. Mm-hmm. So as it gets adopted, and that's the other thing in the speech that I'm going to give, we're kind of at the 10% penetration point worldwide on Bitcoin. And if you look at like the internet, if you look at any technical innovation, this is Malcolm Gladwell, tipping point. If you look at technical innovations, they tend to, when they get to the 10%, it's like it rises to a level where a lot of people know about it. And then it closes the 10 to 80% pretty quickly. I say quickly, 5 or 10 years. Cell phones is an example. I've got a chart in the thing I'm going to present that shows it. The cell phones, in the beginning, nobody has a cell phone. 10 years later, 14 years, everybody's got a cell phone, right? And I kind of think that's what's going to happen with Bitcoin. I think everybody's going to start saving in Bitcoin because they're going to recognize what it is. And once they understand that, they're going to see that it's the soundest money out there, and the soundest money tends to win. Mm-hmm. So,
Larry, you mentioned the energy input cost of Bitcoin and of gold. And with oil nearing multi-year highs here, is this going to continue to exacerbate the raw costs of everything to keep?
I think climbing? It is, and I think it's interesting that you mentioned energy, because I'm more and more as I read and study, I'm coming to believe that money really is just energy. Everything that's energy related is measured in money, and everything that's money is kind of measured in energy. And so, arguably even oil could be a good form of money. It has its issues, but the point is that gold is the stored energy that it takes to mine it. Bitcoin is the energy it takes to keep the network running. Oil is the energy that runs the world. And, one thing I will point out, though, I know one of the knocks on Bitcoin is that it absorbs way too much energy. And I think that's a false criticism, because I've seen studies, Nick Carter's done some great work on this, that show that Bitcoin consumes about 0.4, maybe 0.5% of global electricity. And so, you ask yourself, well, is it worth it to have a sound form of money? Is it worth 0.5% of electrical costs worldwide to have a sound form of money? I would say the answer is yes. And you and I were talking beforehand. I have not done the math, but I will do it. I'll bet we spend more than that mining gold today, more than 0.5%. And I know we were talking about this as well. I know the U.S. military consumes 1% of the oil consumed every year, every day worldwide. And I'm pretty sure that's more than 0.5% of the energy in the world. So the point is that, anything that's money, having a sound form of money, is going to consume energy. Banks consume energy. Every business consumes some energy. The issue is that energy being used well? And I think in the case of Bitcoin, as in the case of gold, it is being used well because it's creating sound money. The energy that's not being used well are the, 20,000 people that work for the Federal Reserve. I don't know how they need 20,000 people. They need one guy to push the print button. That's it. That ought to do it. So
that's a great point, Larry. Is there anything else you'd like to add before we wrap up here?
No, not really. I just, to the gold guys, I would just say, hang on. The Bitcoin people are feeling pretty good right now, and they're rubbing it in our noses a little bit. And I remember when Bitcoin was stuck at 6 and gold was ripping. And one point I would make is they tend to be a little bit, to me, gold is kind of like a bond and a little bit of a risk off, preserve your purchasing power, safety trade. And, Bitcoin is kind of your wild and crazy growth stock. And, when things are flowing and everybody's pulled up, they're going to chase Bitcoin. And so right now, Bitcoin's bumping at the old highs, might break out to even newer highs, and go on a tear. And gold's feeling a bit left behind. But I think over time, they're both going to go up a lot. There's plenty of room. I would say this, and this is an important point to make. The $450 trillion of financial assets in the world. So that's cash, stocks, bonds, and money basically out there. 450 trillion. Bitcoin market cap 1.1 billion. Gold, tradable gold market cap. There's a lot more gold, but some of it's in central bank vaults and antiquities. Tradable gold market cap 5 billion. All the tradable gold and silver stocks 1 billion. So you've got call it 7 trillion. I'm sorry, those numbers all should have been trillions. So you've got 7 trillion of what I consider sound money alternatives: Bitcoin, gold and silver stocks. You got 450 trillion of fiat stuff. Okay. When that 450 trillion, a lot of it is in bonds, by the way, over 100 of that is bond, or 150. When that stuff realizes, holy cannoli, they're printing this like crazy. I am getting debased. I am not maintaining my purchasing power. I need to find an alternative that does. That's going to come chasing that 7. And I don't know what the split will be. Obviously, maybe more of it goes into Bitcoin. I don't know. They're both going up. They are, it's not like gold's going down and Bitcoin's going up. They are both going up. Maybe Bitcoin goes up faster. Maybe it doesn't. I don't know. The millennials will obviously flock to Bitcoin. The boomers who happen to have a lot of the money, some of them don't trust Bitcoin, and so they're going to buy gold. But my point is that inflation will drive a trade out of fiat and the fiat assets and into the gold assets. And in the 80s, gold represented 7% of world financial assets at the time. And so right now, gold is like 1% of world financial assets. So, if you take 7% of the 450, it's like $32 billion worth of sound money assets. So what I'm saying is I'm saying billions, I meant trillions, 32 trillion. The 7 trillion that we now have of gold and Bitcoin could easily grow to be that 32, easily. And that's if we only go to the 80s. I think we're going way beyond the 80s. That's the 79, peak in gold, because I think this is the end game here for fiat. So I think it's going to go a lot larger. My point is that, sound money ought to do a 5X, in this bull market. And if and when fiat totally fails, which I think it will, it'll do kind of an infinite X, because we won't be measuring in fiat anymore. We'll be measuring either ounces or Bitcoin. So what I would say to everybody is just, sit tight and be patient. These things take time. The Roman Empire didn't fall instantly, and fiat's not going to fail instantly. But I'm 64, and I'm not worried about seeing it. It's happening. It's probably happening within 10 years. I actually feel like it could be happening within 2, 3, 4 years, based on the slope of the money supply growth curve and the amount that they are going to need to print to keep this thing going. So chin up in spite of kind of a shitty gold tape. I know there are days I wake up and I look at, I wake up this morning, gold's down. I look at, God damn it. What's going on here? It's just very, very frustrating. But we're in the right place. I have very little doubt that we're in the right place. So hang in there.
Excellent, Larry. Well, it's always easier to have a bit more conviction with a perspective like yours. Of course, your quarterly letters are available at ema2.com along with some more of your information there. And you're very active and entertaining on Twitter at Lawrence Lepard. Of course, we'll have those in the show notes for everyone.
Yeah, great. Thank you very much. It's always fun to be with you, Tom. You really do your homework and ask great questions. I always enjoy it. Thanks so much.
I appreciate your time as well, Larry. Thank you. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.